Let's give it just one more minute, let everyone in. Okay, good afternoon. I'm Bruce Choi from the Global Risk Institute, and I'm delighted to welcome you to today's webinar on infrastructure investment. Now, although this event is virtual and many of you are joining us from across Canada and around the world, I'd like to acknowledge that the Global Risk Institute is headquartered here in Toronto, which is situated on the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, the Wendat people, is now home to many diverse First Nations, Inuit, and Métis people. I also acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. Please note your microphones have been muted to avoid background noise, but we would like to integrate your questions and comments, which we'll take through the chat function at the bottom right-hand corner of the screen. We'll address as many questions as we can through the Q&A portion of the event. When you leave the webinar today, a survey will promptly appear. Please ensure you fill that out, as your feedback is valuable for us to ensure the future programming considerations. So let me introduce you to our speaker today. First up, we have Dr. Steve Bonner. Dr. Bonner is the former principal of Towers Perham, where he worked for over 30 years providing thought leadership in investment and financing of the pension plans. He's also a postdoctoral fellow at the University of Waterloo, an author of a study that will be briefly summarized today in connection with the connection between population structure and the returns on infrastructure investment. Following Dr. Bonner's presentation, we'll have a panel discussion with a number of infrastructure asset class experts who will join us on the virtual stage. I'll introduce them after we hear from Steve. So with that, let me hand it over to you, Steve.
Thanks, Bruce. Thank you. That's been moved forward. So the paper that we put together is meant to address this particular research question. Are infrastructure returns affected by population structure? And our initial objective was just to get a simple yes/no answer to this particular question. And as it turns out, the answer is yes. So that gives you the bottom line. But let me take you through, obviously, some more information on this. Could I get the next slide, please? So just want to acknowledge a couple of things. This is a sub-project of a much larger research agenda that started, 5 or 6 years ago, entitled Population Aging, Implications for Asset Values and Impact for Pension Plans and International Study. So we've had academics involved in this from both Canada and the UK, in practice areas of economics, finance, and actuarial science. This particular piece of work is focused on that middle item, implications for asset values. And we also acknowledge with thanks financial support from a variety of places, including the National Pension Hub of the Global Risk Institute. So if we could just move to the next slide. Thank you. So as background, Canada is a leader in investing in infrastructure and pension plans, but globally, infrastructure is increasingly being used by pension funds. And it's kind of natural in my mind to think that infrastructure should have some connection to the structure of the population. After all, it's being built out in order to support a particular population. What was strange is that when we looked at the literature surrounding this, there is all kinds of academic work looking at the connection between population structure and equities and bonds, starting from a seminal paper in the early 90s, and population structure and housing, sort of running from a seminal paper in the late 80s. So over the last 30 years, there have been roughly 100 academic papers addressing the connection between population structure in these particular asset classes. But there's been nothing on infrastructure. And so that was our motivation to start looking at this. Thank you. So the literature on the other asset classes is, as I mentioned, it's large. It covers many different time periods, all kinds of countries. And if I were to sort of take the big leap and try and summarize the results, and it's a little dangerous to summarize 100 papers in two separate lines here, but when you look at the ones that looked at using working age population as a demographic factor, rough idea of the impact is that a 1% increase in the working age population increases equity returns anywhere from 1.5% to 5% per annum, was what the various papers found. And it dropped bond yields anywhere from 1 to 1.5%. Looking at the proportion of the population over age 65, or more properly, I guess, age 65 and older, a 1% increase there drops equity returns by about 0.5% a year and drops house prices by anywhere between 0.5% and 1.5%. And if you think of it from the perspective of a pension plan, that's a particular issue in the sense that longevity is going to, increasing longevity is going to work to increase the liabilities of the plan at the same time as it's depressing equity returns and to a certain extent housing returns as well. And so that is particularly damaging to the financing of pension plans. So on to what we found. At a very high level, as I mentioned before, we do find a significant relationship between population structure and infrastructure returns. And I'll note here, and I'll come to more detail later on, that we proxy infrastructure returns by appropriate weighting of certain equity market sectors. That relationship is stable over time, but it was overwhelmed during the financial crisis and the euro crisis. So there was much more variability going on. We didn't get a significant signal at that point. And importantly, what we're picking up is not just the general relationship with the equity market as a whole, because we found no significant relationship in any other equity market sectors other than healthcare. And that was an interesting result in my mind. That's the key finding of the work that we did. So let me just take you through what it is we actually did and get you to forward the slide. Thank you. So it's difficult to get infrastructure data directly. The returns on individual infrastructure projects are really only fact-based at the point when you divest yourself of an infrastructure project. So there's huge amounts of difficulty there. So we followed an approach taken in another paper by Amar and Ealing, a 2015 paper, where they appropriately weight certain sectors. And here we used US equity market sectors and industries. So the telecommunications and utilities sector and the transportation industry we used as a proxy, and we weighted those returns based on their free float market capitalization. And just as an aside, all of the analysis here is done on the US. We look at monthly returns over the period 1990 to 2016. And we acknowledge that the returns on traded equities are likely going to understate the expected returns anyway on infrastructure because of infrastructure having less liquidity and therefore getting expected to get some premium for that. Basically, our view is the analysis and conclusions hold as long as that liquidity premium is not related in sort of offsetting the connection between the equity market returns and population structure. So in terms of analysis, we follow another paper's approach, a paper published by Ang and Mataloni in 2005, and we regressed infrastructure returns against three demographic variables: the change in the average age of the adult population, the change in the proportion of the seniors population defined as age 65 plus, and the change in the proportion of the working age population. And we also included two economic variables: the aggregate consumption component of GDP and the term spread, the spread between 10-year treasuries and 90-day T-bills. Again, all of these factors are US-based. The population structure is US-based. Consumption is the US component, that component of US GDP, and the term spread are based on US instruments. So our main finding on the next page is that, and this is a bit of a repeat, there's a significant relationship between population structure and infrastructure, and I'll dive into that a little bit more in the next slide. And no, I don't want to go there yet. And of the other equity market sectors, population structure really only has a significant relationship with healthcare, no other sectors. And we did a lot of work trying to demonstrate that. So what we were picking up in that first observation, the relationship between population structure and infrastructure returns, is specific to infrastructure. It's not a general characteristic of the equity market. So our base results on the next page. So all of the variables that we chose are statistically significant. I'll talk about their economic significance later on, but they're all statistically significant. So what I'm describing on this page here are marginal returns. So let me explain what I mean by that. That first bullet point is the average age of the population increases, the returns on infrastructure go down or are depressed. That is true as long as you hold all of the other factors constant. And I'll talk about the implication of that in a second. So average age goes up, infrastructure returns go down, simply put. As the proportion of the seniors increases, infrastructure returns are higher. As the proportion of the working age population increases, returns are higher as well. And if you take all these three things together, what one way of thinking of it is that a smaller young cohort under the age of 20 is positive for infrastructure returns as long as it's not also contributing to an increasing average age. So there isn't, unfortunately, one simple intuition around this. There's a lot of interplay among these demographic factors. The two economic factors give results that we kind of would have expected. As aggregate consumption increases, infrastructure returns are higher. That's basically saying as the economy is booming, that's good for infrastructure returns. And as the yield spread between 10-year Treasury bonds and 90-day T-bills increases, infrastructure returns are depressed. So as you get a steeper and steeper yield curve, putting downward pressure on the economy as a whole, that will also serve to depress infrastructure returns. So those two factors shouldn't be surprising and weren't surprising to us. We then looked at the sensitivity of the results to different time periods, which is on the next chart. Thank you. So we looked at, well, we looked at a whole slew of periods, but what we highlighted were 3 overlapping 15-year periods, basically what we could do with the data that we had. And over all 3 periods, the direction of the relationships, as I set out on the previous page, remain the same. But in the middle period, from 1996 to 2010, the results are no longer significant. So the financial crisis caused a whole lot of sort of extraneous variation coming in, so that we couldn't pick up the more subtle signal from the demographic factors. If we also looked at the results if we excluded the years of the financial and the euro crisis over the full period. So we looked at 1990 to 2016, but excluded the years from 2007 to 2012. And what we find is that the demographic relationships retain their same sign. They are larger in magnitude, so the coefficients of the demographic variables are larger in absolute value, and they retain their same sign. So increasing average age depresses return, increasing working age population and increasing seniors population enhances or increases return. So that then leads us to a few conclusions and implications. So the conclusions on the next slide. And I'll repeat this yet again. There's a significant relationship between demographic structure and infrastructure returns that is statistically significant. So all of the variables are significant at least a 5% level. And it's also economically significant. The marginal effect of changes to those demographic factors, if we sort of move a standard deviation one way or another, the impact on of a one standard deviation move in the average age of the adult population depresses returns by 2.9%. And a one standard deviation movement in the proportion of the working age increases returns by 5.6%, and an increase of one standard deviation in the proportion of the seniors population increases returns by 3.8%. Those aren't 3.8, that's not 3.8% per annum. That's just an increase of almost 4%. So that relationship is stable over time, but it was overwhelmed by the impact of the financial crisis. And there are no relationships anywhere else in any other equity market sectors with the exception of healthcare. So what we're finding is very specific to infrastructure or infrastructure sectors in the US equity market. And the relationship for infrastructure is different. The relationship between returns and population is different from the relationship for other asset classes. So that may well provide some diversification benefit or an argument for diversification benefit. And then just a few implications before or as I conclude. If you're including infrastructure, for that matter, other asset classes as well, in an economic scenario generator, it's highly likely that you'll get enhanced results by reflecting demographic variables in that economic scenario generator. And just of note, there's a prior paper that we did for the National Pension Hub of the Global Risk Institute that does just this and illustrates that for a Canadian pension plan. It's important to think about that because pension plan finances are also exposed to longevity risk on their liability. So not only is there potentially downward movement on asset returns in an older population, there's upward movement on liabilities as we get increased longevity. In perhaps the most interesting thing when you just focus on the asset side alone is that the relationship between demographics and returns within the equity market are quite different sector by sector, and that should be reflected on when in future work on equity markets. And so that's the end of my piece.
So thank you, Steve, for those interesting insights. At this time, let me introduce you to the rest of our panelists, so most of whom have had decades of experience in the complexities of infrastructure as an asset class. So firstly, I'd like to introduce Dr. Jaideep Oberoi from the University of London, who is also a co-author with Steve on this paper that was just presented. He was one of the demographics experts who contributed to the work. Next, Michael McGowan, principal at Mercer Alternatives. Now, Michael is based here in Toronto and has been in equity research teams of two of the big Canadian banks before joining Mercer to consult on infrastructure investments in the North American market. And finally, Dr. Alexander Androlov from the Business School at the University of Amsterdam, where he's an expert on institutional investing and can help add a global perspective on our proceedings today. So welcome, gentlemen. So Jaideep, I'm going to turn to you first. As a co-author and particularly that demographics element that I find quite fascinating. Anything you'd like to add to what Steve has presented?
Thanks, Bruce. So Steve gave a really good emphasis on the interpretations that we should draw from this. I would just say I think I would like to emphasize one more time the key point is that we have when we have a lot of studies that talk about demographics affecting predicting asset returns. And so the mechanism through which it's coming in is through this kind of valuation effect. So it was kind of natural to wonder what particular industries it would affect more. And it came as a bit of a surprise to us that infrastructure, which is the one thing that a lot of people who are exposed to longevity risk are investing in, is a particularly vulnerable industry when it comes to demographic exposure. So not including it on the asset side could be quite, when you're modeling your risks, could be quite an error in a sense. So that was like the core emphasis. I would put a couple of small caveats to our results in terms of the numbers. So of course, Steve has already emphasized that we've used industry equity sector numbers. So the returns, when you interpret them, we have to be a bit careful about what we can say when it comes to actual infrastructure project returns. And the other caveat I would put would be to the international aspect as well. So the relationship between demographics and equity returns in particular, or asset returns in general, is not universal. It's not globally the same. So there are some sort of outliers. So it's a little bit, one has to be a bit careful when we start to take this outside the US data a little bit.
Do you have an example of that outlier?
So
make it more concrete?
Yeah, so for example, in a few European countries, we don't find this kind of strong valuation effect on asset valuations. So the question is that because the infrastructure element is not that strong? Is it if we were to break down the data, that's something we need to do. Would we discover that actually it's still the infrastructure as a class is still exposed within Europe, but maybe all of the equity sector together is not exposed? That's kind of work in progress for us. So we've got a couple of other projects where we're trying to look at the valuation effects from this from long-term forecasts of dividend price ratios combined with the demographics. So through like a two-stage prediction, and that's where we might be able to get a few more answers. So hopefully we'll be able to give some more information in the future.
Okay, before we leave the paper, Steve, I might fire this over to you. So Caroline's got a question just to clarify some of the work that you've done. So she's asked about this relationship with the population over 65 increases with equity returns. Research then shows no relationship between most equity sectors and demographics. Have I understood this right?
Yeah, the short answer is you have understood it correctly. You then go on to say, are these contradictory? And I don't think they are. Really, what we're seeing with respect to this particular country, the US, in this particular time period, is that all of the impact of, or almost all of the impact of demographics on equity returns are concentrated in four sectors. Healthcare, which was the other one that we identified, telecommunications, utilities, and transportation. Transportation isn't a sector, it's an industry within a sector. Hopefully that clarifies it.
I hope so too. So I'm going to move on from that. So with your paper, you did mention that the financial crisis did kind of put a lot of noise in and changed a couple of dynamics. And this is where I actually want to pass the question over to you, Michael. Is in we've just had a pandemic, and we're going to see some changes in the way that infrastructure performance will occur and may propagate into the future. In the discussion we had before this meeting, you mentioned to me things. If it moved goods, it went well. If it moved people, it suffered this time around. Would you like to elaborate how infrastructure as an asset class is looking today?
Yeah, I think investor demand. Fortunately, it's still it's a really good industry to work in because investor demand towards the whole asset class is quite strong. I mean, here in Canada, Steve mentioned that we are leaders in investing in the asset class. So if you don't have an allocation to private infrastructure, hopefully that's something that you're taking a look at. We are seeing a big movement in the US, and it comes back to this concept of resiliency. And this is something that should have always been a part of infrastructure. So where we're seeing allocations move in the United States is clients who had direct, I would say, energy exposure or real assets exposure are actually transferring some of that over to infrastructure because it's seen as more resilient and less volatile. The nature of what is resilient is also changed, or the concept of what is resilient has changed. So in the past, you would ask anybody and they'd say, well, toll roads, airports, those are great infrastructure assets. Well, what we saw during the pandemic was if you had an asset and it moved people, it did not do very well. If it moved goods, actually it recovered very quickly, and valuations now for a lot of good bearing transportation assets are much higher than they were at the beginning of the pandemic. Whereby if you take a look at airline volumes, they're still about 20% down of where they were on basically just general output. So I think that in a large part is people want to go on vacations, but the concept of business travel, that could be permanently impaired, and that's creating a lot of uncertainty. So it's just this whole concept of resiliency where people are looking to invest, and that's really what the pandemic drove home.
And Michael, I'd like to continue on that. Is it fair to say that the structures also changed a bit in the financing? The investment landscape's moving to more of a private equity field than what it was in the past?
Yeah, I would say the private equity construct has been around for quite a while. Traditionally, when infrastructure was, I would say it's not a new asset class because it's always been there, but the concept of infrastructure investing, like a lot of the Canadian pension funds or the Australian pension funds would go out and directly buy these assets, and not a lot of the smaller funds could access this area. So they went through private equity funds. I would say maybe the risk profile of the private equity funds has changed over the last few years. These funds, because they have certain return hurdles to meet, they would invest in more value add type assets as opposed to the traditional core type assets that most investors would have thought of, because those had either been purchased by pension funds and not disgorged, or they're just, they'd be held for a longer period of time.
So I'm going to switch to a little bit of a global perspective with you, Alexander. Have you seen this same sort of shift in I guess, return profile of infrastructure assets in recent times?
Yeah, I think one interesting aspect that Michael brought up is private equity kind of investing has been there for a long time, but I think it's the fastest growing investment structure in infrastructure. I think the large Canadian, Australian funds were investing directly, but this approach was not available to smaller institutional investors. And I think especially in US, they moved more towards closed private equity style funds, and they're the dominant structure in the last years in infrastructure. So we looked in a paper in terms of like what kind of cash flows and performance this closed infrastructure funds deliver. And what we find is that at least we interpret it as a significant mismatch between the expectations of investors and the kind of the outcomes that they get. So pension funds usually go in infrastructure for long-term, stable, dividend-style cash flows, but they access it primarily through these closed, finite horizon funds. And the cash flows that they get from them are primarily driven by deal exits, buying and selling decisions. And in that sense, the riskiness of the cash flows is very similar to any other private investments like private equity buyout funds, private equity venture capital funds. So the cash flows and return profile of these closed infrastructure funds do not differ from them. So in that sense, I would say they don't justify the different expectations that pension funds have for them if they use this structure. And this is the dominant method globally, let's say. Also, if you look UK funds, European funds, etc. Only the large funds are exceptions that kind of try to go directly and maybe hold assets longer.
So anyone can answer this one. Does that mean that the old rule of thumb of infrastructure being that inflation hedge is starting to break down? Will it work in this new rising inflation environment that we're moving into? Anyone want to take that? Or should I fire it at someone? Michael first, given it's directly into markets.
So when I talk to investors, I like to say that infrastructure is an idiosyncratic asset class. Like every asset is basically governed by its own rules. So you could have something that's identical in one market, but it's the return profile is completely different depending on the regulatory construct that you'd see. So in terms of inflation, I think historically infrastructure has done pretty well, and I think it will continue to do well, but it depends what you invest in. So if you're investing in a utility, direct pass-through of costs, so you should be relatively fine. Conversely, utilities tend to make more money when inflation is high, because if bond yields are a component of your return on equity methodology, then you'll be allowed to earn a higher return on equity when rates rise to combat inflation. Things like assets that have certain tolling agreements or availability agreements, usually there's an inflation clause built right into those. It's when you get into things, so they can pass through inflation as well. When you get into things that are more merchant, such as uncontracted power or basically asset with a lot of revenue variability based on volumes, then that's where that relationship tends to break down.
Any other?
Add a little bit,
Alexander?
Yeah, I think what's interesting is that I don't think infrastructure has been tested so far with inflation. I think it's a relatively young asset class, and most of the infrastructure assets that are investors' portfolio are located in countries that had relatively low inflation in the last 20 years or so. So I don't think we had so far a proper test of the inflation hedging properties of infrastructure. So going forward, it will be interesting to see how it performs. I also sort of related to Michael's point that a lot of these assets have built in kind of this inflation kind of increases in pricing, etc. It will be interesting whether this goes through, because we know from some emerging markets when assets have this type of provisions built in, they're followed by protests by the users and the governments can back out, or the regulators. So it will be interesting to see whether in the next period kind of these clauses will turn into kind of automatic inflation adjustment, or whether there will be some pressure to avoid that.
Yeah, I don't think we can say much about inflation protection only from the analysis that we did for this particular paper. I mean, equity returns as a whole while they have generated returns in excess of inflation, their linkage or correlation with inflation is particularly low. So they aren't generally a good hedge against inflation, though there is something to be said for returns.
Mm.
And so, if I mean, the only thing we can link up with aging, for example, this other work that we did, we found that when you find in an international context, when you have very old populations, those are linked to lower inflation, disinflation, or even deflation. So, if there's any contribution from the population mix on your inflation profile, then it's going to happen in aging economies. And in fact, that's going to lead to lower inflation. So, if there is any link between from the aging and demographic angle with respect to infrastructure, then it's not exactly going the way like in terms of it wouldn't necessarily act as a great hedge in an aging population. It's probably less likely to do that.
Yeah, no. So demographics will be an interesting risk area. We've just spoken about inflation, which we're moving into this uncertain period. So I'm going to pivot once again to another aspect that the infrastructure will play a massive role in, and that's the climate change net zero targets. There's going to be a lot of infrastructure that's going to be required there. Michael, I might start with you first. We're talking about a lot of long-term investments with a lot of riskiness involved, and the paths to net zeros are still not there. And at the start of these major infrastructure projects, so there's a potential that capital gap, as in whether investors are willing to take that risk in there, or whether that needs to be supplemented by someone like the government coming in. So could you talk a little bit about what you're seeing and what you see how that could play out?
I think it really depends on the scale of the investment. For example, like a very large mega project, that's something government obviously needs to step in on and build, because there would be a mismatch between the return on capital that a private investor would seek out versus what the public may be willing to bear in an early stage development. I will say though, the energy transition has got a lot of interest from private investors, and I think that's because energy investing, especially in North America, has largely been it is regulated to a certain extent, but it's also it has been traditionally the main form of private main attraction for private capital infrastructure investing in North America. So wind and solar, a lot of that has been that's private capital. Government policy certainly helped shape a lot of that investment, but private capital did chase it. If you're talking about a huge mega project like one of the dams that Hydro-Quebec builds, then the government needs to step in there. But in terms of like some of the grid investment, distributed generation, those types of assets, we're seeing lots of investor interest there.
So are you seeing any places where there's a potential warning of a capital gap?
Yeah, probably some of these things, like I would say hydrogen at this point, like people are interested in it, but it's not economic. So, people like to talk about it. Or, for example, carbon capture is probably a really good example, because there's no end use for carbon capture. Like you're not unless you're using carbon for enhanced oil recovery, which is definitely not ESG friendly. You're just storing carbon in the ground indefinitely, which increases basically there's a cost associated with that. So solutions like that, I think, need some sort of government support.
Alexander, how are you seeing that in the global context?
I think what we did in our paper was we looked at the performance of around 1,600 investors, and we tried to understand how much non-financial objectives like ESG objectives drive their allocation to infrastructure and performance. So what we find is that especially public institutional investors, so think about public pension funds, sovereign wealth funds, and government agencies, have increased rapidly their allocation to infrastructure. And we find especially investors that have stronger kind of ESG objectives and preferences have started to invest more. To do this, we proxy with signatories of UNPRI. So I think if you're a signatory of UNPRI and coming from public sector, I think those are the kind of institutions that increased most their allocations. That's what we find. However, what we find is that these are the investors that also obtain the lower performance. So we find that tend to underperform in infrastructure, and that's controlling for types of deals, controlling for industries. And one important driver of the underperformance seem to be impact funds. So we find that these funds that have explicit kind of dual objectives, etc., they tend to deliver, let's say, for example, in the private equity space, when we look at these private infrastructure funds, they tend to deliver significantly lower, like public market equivalent, multiple of invested capital, etc. So there seems to be kind of investors are aware of the importance of this impact. They are aware of these other objectives beyond performance. And it looks like some institutional investors are willing to pay price for these benefits that have societal benefits, or at least they're taking part of the kind of return hit there in that space. But we do see that kind of, let's say, if you engage in impact investing, it can affect your performance in that set.
Michael, do you feel that there's potentially a European phenomena, or are you seeing that same sort of willingness to take that return hit in the North American market?
You know, investors here historically have been more comfortable with investing in, you know, assets that emit, basically hydrocarbon investing as well. You know, we work with colleagues in Zurich and London as well, and I'm a little surprised every time I talk to them just how, I don't know if hostile is the right word, but how averse even a lot of those investors are to investing in natural gas. I know that natural gas was recently named part of the energy transition, but still, like natural gas it does emit. Here, some of that sentiment is growing, but there's still more of a, let's say, acceptance of investing in natural gas or related assets like that. You know, we've also seen reluctance, probably from both North America and Europe, more in Europe, of some investment strategies that target, that will invest in emitting assets, but they target reductions from those assets. So a good example that I can give is, you know, we know a lot of managers or investors that have started to put batteries on natural gas facilities in order to reduce their emissions. Some investors, and that's a good idea because you can dispatch without emitting at that point and still provide grid stability. But some investors just won't invest in that because it is, well, it's like, well, it's a natural gas plant. I can't do that. So you know, it's really, you know, I think investors would probably be better served with looking, instead of just a clear mandate of exclusion, looking at carbon reduction as a good, you know, good way to help the climate crisis.
And what about you, JD? Being in London, how are you seeing? I guess the infrastructure investment side, and I guess that move, the more climate focused for European market.
So I have more personal experience of this than from an industry from a sort of a industry perspective, but I've seen the questionnaires coming out from the pension funds, for example, and they're really focused on this. So they're on behalf of all their participants, they're asking these questions, and they're getting back responses which say that they have a higher so they're giving them sort of the authority, in a sense, to invest in sort of the impact side of things. So implicit in that is in the questionnaire, you typically see a question like, you know, are you happy to give up some proportion of return in exchange for this outcome? And so these things are implicitly tied together, and I think even the end investor understands this. So there is quite a move towards that for sure. I can see that here, but I can't give you like statistics or any kind of aggregate figures.
Hey, so I'm quite interested in that. How long has it been since you've been getting these questionnaires? Because we have all the pension funds from Canada online at the moment. So I'm not sure. I've yet to see a questionnaire from them for myself. But how long has it been happening in London or in the UK?
So for example, the USS fund, which is the University Superannuation Scheme in the UK, is one of the biggest private funds here. They have at least been doing this for at least 2 to 3 years now. So So I think around 2 years ago, there was a very explicit question I sent out asking people for their preferences. So I think recently I've seen an update saying that they're actually going ahead with reporting how they're doing on their ESG investment performance. So they've moved to the next stage, in a sense. So,
Okay.
yeah. So I'm not sure about the exact dates, but I think it's been a while now that they've been working towards this, and they're not the only ones that I've come across other people who've seen these kind of questionnaires as well.
So I wonder if I could ask a follow-on question of JD. You talked about the questionnaire asking about the trade-off between return and reduced impact on climate. It seems to me that individual members of the plan, their trade-off is between what benefits can be provided and the impact on the planet. Has that been attempted? Has the USS attempted to try and get at that more sort of individual level trade-off?
So, I should be careful. So, I don't want to say specifically about the USS because this is
Okay.
an
No,
this is an implicit reading of what I saw in the questionnaires. So they don't want to explicitly say it in these terms, right? But partly for the reason that you've raised, Steve, that when you link it to benefits, then people might have a different opinion.
Yeah.
But yeah, you're right. It hasn't been linked to benefits directly. Not as far as I've seen.
So I have a comment from the audience saying that one thing to keep in mind is the much higher proportion of the defined contribution plans in the UK relative to the DB plans that we have here over in Canada.
But maybe to come back to that, I think Netherlands has still a lot of DB, even though it's transitioning into defined ambition or whatever is the new term for that. But I think the difference is, let's say, okay, the Dutch market has a strict regulator compared to North America, but the DNB required from all pension funds to kind of ask their participants for risk aversion and other preferences with questionnaires already for a very long period of time, I think for 10 years or so. And I think these questions have been obvious and they're like in terms of impact and performance, etc. And let's say they have even asked questions like, are you willing to sacrifice performance for this, etc. And it comes differently from different sectors. Let's say from metal sector workers, you don't get so much, but from retail sector, then you get much more. So there are differences among plan participants in their preferences. And I think some pension funds try to incorporate that in their asset allocation decisions. It is definitely interesting what will happen in the future if this results into some kind of different benefit distortions. Will there be complaining kind of afterwards? Will the ball be passed back to the government if there is inequality in the pension benefits and so on? So I think that's something that it's not obvious because pension contracts are always renegotiated.
So Steve, more demographic cuts that you can experiment with in the future.
Yeah, exactly.
So we'll pivot off climate. Climate's one where I suspect that there's going to be quite a boom of infrastructure investment that's required for us to even have half a chance of meeting our net zero targets. So I'll switch it back to Michael. What other infrastructure subcategories are there that we should be watching closely?
The other big sector that most people have been paying attention to is digital. Digital wasn't considered mainstream 2 years ago, but look at how we're meeting these days, 2 years into the pandemic. So digital is essential. There is sort of a fear with digital that valuations may be stretched, and I think there is certainly an argument there, especially if you're looking at historical norms. But the raw increase in data over the next 5 years probably allows for some of those high valuations. However, our comments to investors are just if you are investing in digital infrastructure, like make sure that you're investing with an expert instead of a generalist, so they have a good view on the landscape. We did talk about the energy transition. One of the most recent phenomenons is more of a return to core. So that's not really a sector, but it's more of a phenomenon. So there weren't that many large core pension funds. There's a lot of pension funds that were looking for core assets, but there weren't that many investment managers that focus on core. It's traditionally been these closed-ended funds, whereas now almost every large investment manager we've had a number of new entrants last year. I think there's going to be at least 6 or 7 new entrants this year that are launching open-ended core funds. So that is, a new development in the space too, and that has implications not just for the types of assets that may become available, but it also has just wider valuation implications if there is this additional layer of capital that is looking to invest and also potentially prop up the valuations of these value-add funds.
Mm. So Steve or Jada for this one, the traditional infrastructure where we be it a toll road or airports, a little bit more localized in their benefits, and you could put that demographic lens on it probably more appropriately. Digital becomes a different beast that Michael's introduced. How would you guys see that?
Wow, trying to capture that would be difficult. I mean, we have looked at relationships between infrastructure and returns in general, not infrastructure, between population structure and returns in general on a global basis. And in particular, we tried to have a look at that for general equity markets as opposed to infrastructure, where money sloshes around the globe, but a particular population is more nation specific than that. And we ended up running into a dead end. That's not directly answering your question, but it's coming at the point that the less connected a particular investment is to a particular location, the less impact any country's population structure is going to have on that investment, either directly or indirectly. One way we thought of dealing with it on the equity side was to think of developed markets as a country, or having one population, one overall population, and how do equities react to changes in that overall population. And I can't remember the specific answer that we got, but I remember it wasn't startling enough for it to proceed to the point of drafting a paper. So we didn't get good answers there. And so I have a feeling that if you sort of draw a parallel back to digital infrastructure, where there's not necessarily any underlying population other than a global population that's affected by it, that you're not going to be able to get great results, great linkages between population structure and their returns.
So if I could just sorry, so just to add to that, so the digital is like a kind of a game changer in a sense from many perspectives, right? So one of the things that's happening after the pandemic is that even the labor force is changing, and the use, like for example, the ability of older people to work more and access the workplace potentially could change. So many things are going to change that it's almost impossible to predict a link between the two. Why? If you go back to like the 30s, Keynes was predicting a total disaster in equity markets because he thought the population was crashing in the 1930s. And then we had the baby boom. So the pandemic hasn't brought a baby boom, but will the digital infrastructure completely change the working profile of the population? Will younger people work less? Will older people work more? It's going to be very difficult to predict. So there is some potential for digital to affect the relationship between demographics and the economy rather than vice versa.
Now, I must say, interesting risks and opportunities in this particular asset class as we go through the demographics of population. We just talked about future of work that you just mentioned. We've already covered inflation, all the climate infrastructure that we'll need to build, and Michael's told us some of the hot areas that we're going to be looking at, particularly on the digital side and back into core. But I do want to know that it's almost top of the hour, so Steve, I want to leave it with you for a final comment. As in, I guess, can you bring it back to a whole balance sheet perspective of why we're doing this work?
Yeah, I mean, I guess I'm influenced by my years of training as a pension actuary that thinking about the assets alone is only part of the story. That pension funds in particular are exposed to longevity risk on their liabilities, and they need to think about how that is either mitigated or exacerbated by the same kind of risk exposure that they have on their assets. And again, just to put in one plug for the prior paper that we did for the National Pension Hub, we did have a look at that. And basically, if we get negative surprises with respect to aging populations, in other words, if we get faster aging or greater aging than we currently anticipate, that's bad news for pension plans from both the asset side and the liability side, depressing assets, increasing liabilities. And so it's a risk that should not be neglected.
Okay, so a special thank you to all our wonderful panel speakers today. So Dr. Steve Bonner, Dr. Jaydeep Dobroy, Mr. Michael McGowan, and Dr. Alexandra Androv, and to all the attendees for your participation and engagement in today's rich discussion. So hopefully, all your inputs have been very insightful, and I hope that the audience is able to take away some interesting ideas and inspiration for your work from this particular work. So as a reminder, a prompt will appear to complete a post-webinar survey when you leave this session. Your feedback is very valuable to us, so please take a moment to fill out the survey. We thank you all for joining us at the Global Risk Institute this afternoon, and we look forward to seeing you at upcoming events. Best wishes and stay safe.